So, why do I look at elections? Well, first of all, I look at two types of elections. I look at the national elections internationally, right? That would be presidential elections and presidential systems, vice president elections and parliamentary systems. And I also look at the state level elections, gubernatorial elections, right? So every state has a particular schedule when governors get elected with very specific rules how governors get elected. So why do I look at the elections? Well, these are partly, at least partly exogenous political episodes that are well distributed across countries, across states within the United States and over time. And why do I need both international elections and gubernatorial elections? Well, I will show you that using the sample of gubernatorial elections provides me what I believe is a kind of like more powerful test to deal with some of the econometric issues which I cannot really successfully resolve using the sample of international elections. Well, we already know from the previous papers, at least that was my questions, and I got a sort of affirmative answer, that elections are associated with increase in policy uncertainty and economic uncertainty. So why do I look at the capital allocation rather than the level of investment? Well, the level of investment has been done, and we've seen some previous papers showing that uncertainty depresses the investment level. Here I deal with the capital allocation. What I mean by capital allocation? Well, I mean I deal with investment efficiency. That under good capital allocation, and I'm speaking to audience of very smart economists, and I come from the corporate finance side. So under good capital allocation, capital is channeled to positive NPV project, to value enhancing project, and capital is withdrawn from underperforming projects on the aggregate level or firm level. So I will be also dealing with such issues as underinvestment and overinvestment. So to motivate why election-driven political uncertainty, I believe, is important. I constructed this graph. It doesn't have direct implications from my paper, but I just found this abnormality in 2012. So these are the number of elections, national elections. This is the number of countries, the blue bars. It represents the number of elections. I take roughly 180 countries, and I just classify elections. And they follow more or less like 4-year pattern. Right? Not always. They can be coups, revolutions, endogenous elections, etc. And I also plot the number of countries that belong to the G20 club. And I plot the number of countries with elections. And excitingly enough, 2012 is some kind of abnormality. We have the largest number of countries with national elections, which belong to the largest industrialized, not necessarily industrialized, but largest countries in terms of GDP, G20 countries. So this year we had elections in the United States. We had elections in China. Although you might say there are no elections in China, well, within the party there is lots of democracy, I personally believe. And there is lots of, within the party, they do vote. They do vote. And there is lots of political uncertainty. Right? Although we know that that particular party would win the elections. We had elections in Russia, France, Mexico, India, South Korea, and Turkey. So if you take the...
How many of them are because governments lost power? So how many of them are pre-scheduled? And how many of them are basically endorsements?
United States is pre-scheduled. Russia is pre-scheduled. China, not sure. Was it pre-scheduled? Does it follow 4-year cycle? It's 10-year cycle. India, was it pre-scheduled? South Korea, I need to look.
It kind of links to the Pasteur and Veronese in a broader sense that it's not just policies change, but governments change.
And the governments, yes. Exactly. Yeah. I will be talking about this election. So if you take the aggregate amount of gross domestic product, and you believe that political uncertainty has a real effect on the economy, 50% of world GDP was under some sort of political uncertainty. right? And even if you believe that, like, you know, in Russia it's more authoritarian regime, there is always some degree of political uncertainty.
Something wrong with your measure. U.S. had an election in 2000, and the red line only shows 6% of GDP.
In 2000. In 2000.
U.S. is like a quarter of world GDP.
Yeah, this is correct. That's a good point. I will check it. I will check it. So it's been all over the news. Elections, again, in the United States, in Russia, in France. There's been, capital in France was subject to great degree of political uncertainty, featured in newspapers all over the world. The socialists took power. That definitely, you know, this type of events are significant on how companies react to it. So what's my main message? Well, I show that companies tend to allocate capital inefficiently, and I will define it soon, during election years. For some companies, after the election uncertainty is resolved, the year after election, the efficiency is partially restored, but not for all companies. Not surprisingly, a stronger effect for less certain election outcomes, and there are different ways to measure it. And what I show is that political uncertainty leads to inefficient capital allocation and subsequent worse company performance. So those companies that on my metrics score lower on investment efficiency, they also show subsequent worse performance. So this is what I call the real link, the real effect of political uncertainty. So that's probably not that surprising given this mounting evidence in this conference. What I think is a little bit more interesting is I try to dig deeper, and I try to answer the question how elections affect capital allocation efficiency, investment efficiencies, and why. So I propose two ways to think about this. The first one is the informational view of investment. So stock prices become less informative during election years, making them noisier signal for managers to follow. And here I make a link to the existing finance literature that there is a mutual effect going on. Managers learn from stock prices, investors learn from stock prices, and there is evidence that when stock prices are more informative, managers make better investment decisions. There are different ways to show it, and I will be using some of this evidence. So stock prices is just provide noisy signal to the managers. They're less likely to follow stock prices. And one of the tests I perform, I link investment to prices, and I show the sensitivity of investment to stock prices, and that would be similar to investment to Q regression, is lower during election years. And this is an economically and statistically significant result. I also show direct evidence that prices are less informative during election years. Here I make a link to big literature in accounting and finance, what we mean by more informative, less informative stock prices. Then I further slice my data, and I try to split my sample firm-level data according to companies that are I call politically connected and politically neutral, right? You can think of companies with higher state ownership would be under greater political pressure, more politically connected. I argue that if there is great uncertainty during election year, that should affect the cost of financing. So it's harder for politically neutral companies to raise external financing to fund positive NPV projects and create values. So the informational channel is more likely to be absorbed for politically neutral companies. And if it's harder for the companies to raise external financing, these are the companies that are more likely to underinvest during election years. And what I find is that, yes, politically neutral companies tend to underinvest during election years. However, as the election uncertainty resolves, the year following, they restore their, what I call, normal level of efficiency of their investment. This is one story. Yes? I rely on the existing measures of, for example, the amount of firm-specific information in stock prices. For example, how returns are correlated with future earnings, whether returns are linked to future companies' earnings. And if they are not linked, I call it that information about earnings is not incorporated in the returns on a timely manner. Here, I would say more like about future cash flows, Yes. So this is one side of the story. I have another side of the story, what I call political view of investment. And this is based on more kind of like micro evidence from several papers on how politicians press on the companies to change their investment, which may not be in line of value maximization. What do we know about companies that are politically connected? We know that in countries with state-owned companies with a large fraction of state ownership, companies receive preferential financing during election years. That happens in China, it happens in Korea, it happens in Russia, it happens in the United States if you think about TARP allocation, Trouble Asset Relief Program. More politically connected companies are more likely to receive money from the government. There is evidence that managers cater to the politicians. For example, they want to increase employment at the expense of the shareholders. And this is more likely to happen during the election years. So managers cater to the politicians, and politicians cater to the managers. It goes back to Schleifer and Vishny, state-owned companies argument, 1994, why state-owned companies do not invest efficiently. There is a paper by Maureen Bertrand and her co-authors, how French companies were increasing employment to satisfy the demands of some of the politicians. There is a recent paper, there's a job market candidate from Washington, St. Louis, on the sample of Indian companies, showing that during elections, regional elections, Indian companies take on more pet projects. They have a very great data set. They, for example, they build houses, although it would be not in line with value maximization. So I aggregate this argument, and what I argue is that politically connected companies that are less likely to be financially constrained. So they're less likely to absorb that they would underinvest. If anything, they should either invest efficiently or overinvest. And all these countries, the examples I gave you, France, India, China, Russia, these are the countries that are all in my sample. So what I do find that politically connected companies tend to overinvest during election years. There is an interesting result because I have the statistic on term limits, right? So if you bet on a particular politician, right? If you invest in a particular politician, you want to be liked as a manager by a particular politician, and you increase employment, and that politician loses, that would not be an efficient investment. So I collect information on term limits, right? And I show that this tendency to overinvest is not absorbed when a politician faces term limit, when the politician needs to step down. So this effect of politically connected companies overinvesting, it tends to disappear if a politician faces a strict term limit. Another result is that when I look at the sample of politically connected companies, and I look 1 year after the elections when political uncertainty is resolved, and my argument is that politically connected companies, they have more information than politically unconnected companies. So when information is resolved, they still keep overinvesting, at least for some time. So getting those things together, I show that both politically connected and unconnected companies misallocate capital. Politically neutral companies underinvest. This is due to informational effect. Politically connected companies tend to overinvest. This is my main message. And this is different from the previous research that just simply shows that during elections, Brandon and his co-author has this Journal of Finance paper showing that during national elections, investment drops. So I do observe this effect, but this is not my objective to show it one more time that the investment drops. Because investment drops, it's a rational response. It can be value maximizing decision. So the examples I'm giving here is that when Chinese regional managers build those what's called ghost cities, during increase in uncertainty. That is completely wasteful, ex-post wasteful activity. So they do not reduce investment. Often they increase investment. Well, I'm putting here, I'm serious about indigeneity, but the previous speaker was so serious about indigeneity that I cannot compete here. So maybe I'm serious, but not that serious. So there can be a bunch of econometric problems here, right? Just logically, conceptually. There can be reverse causality. Maybe it's not the election-driven uncertainty. Maybe this is just the overall economic uncertainty that overlaps with the elections timing, and that's what drives capital misallocation. So maybe it's just something we cannot account for, some economic uncertainty. Elections timing itself is endogenous, right? Even a fixed 4-year presidential elections, if a president gets assassinated, for example, right? So I'm trying to deal with these issues. And there are different ways to do it. Like, for example, in the international sample, I can split the sample according to periods of stable growth and unstable growth and show that my results hold for the stable growth some period. I can split my elections according to fixed and flexible elections, right? And show that the results hold for the fixed and flexible elections separately. I can look at some IV estimations. There is some exciting data sets on the assassinations of the politicians, but it's not so exogenous because deterioration in economic conditions probably would make you a more vulnerable target in some parts of the world, right? So this is like standard thing. So I'm trying to be a little bit non-standard. So what I do, this is why I switched to United States gubernatorial elections, right? So think about this. Illinois is one country. I come from Iowa. Iowa is another country, right? So there are some papers, actually, that replicate Julius and Hughes results using gubernatorial elections, right? Investment drops for companies headquartered in Iowa. So why do I need this? Because what I do, I create what I call neighboring states methodology, right? I don't want to take too much credit. This is some difference in difference, treatment effect, control group type of methodology. I just find it exciting to apply it. So I look at gubernatorial elections, let's say in Nebraska and in Iowa, and I make the argument that if there is a company headquartered in Nebraska and company headquartered in Iowa, those two states, you know, to me, maybe because I'm a foreigner, they look very similar in terms of economic conditions. They both were under drought effect, right? So what I do, I can go as far as I identify two companies close to border, right, headquartered, one in Iowa and Nebraska, right? And then I just find those, it's a time-consuming exercise. I find those pairs of, that's what's nice about gubernatorial elections. They're spread all over the 4-year cycles, right? So for 34 out of 50 states, I can find, for every election in one state, I can find a neighboring state without election, right? So what I do, I identify companies in every state, and I constrain my attention to companies that have more than 50% of sales within the state, right? You take like Casey's stores in Iowa. I don't know if they're present in Illinois or not. This is a typical Iowa company, right? So I looked at those companies, and I pretty much take the difference. And I say when they take a difference between an Iowan company and a company in Illinois, that would be a neighboring state, then those unobserved economic effects cancel out. And if it happens that there is a gubernatorial election in Illinois, but no gubernatorial election in Iowa, then whatever I observe, the decrease or changes in the investment patterns or investment efficiency, this is more likely to be driven by elections and not the economic conditions. So, and you know, other than Alaska and Hawaii, we have a nice distribution of neighboring states. So, and if you want to know which state has the largest number of neighboring states, that would be Tennessee. It has 8 neighboring states. So where does my paper belong? Well, it belongs to this literature of politics and finance. Absolutely every paper in this conference should be on this list. It's not. So I cite Bloom and his co-authors. I cite Julian Hughes, National Elections and Investment. I dumped some previous work on elections and volatility. And Pasta and Veronese, two of their papers. So what is my sample? So I have 58 countries. It's a large data sample from 1980 to 2006. It's very unbalanced. In total, 43,000 companies. This is including the United States, 371 national elections. For the United States, which I use for the neighboring states methodology, I have 306 gubernatorial elections spanning from 1990 to 2008, roughly 8,000 companies. This is the universe of Chris Pompeo-Stat. I have to collect a lot of information on state-level ownership for companies in Hong Kong, in Singapore, in Russia. I have to include a lot of controls, the news leakage before the election. So there's been an enormous amount of work. So I use the overlap. There should be like 50 data sets. I'm just modest. I'm putting 15 data sets, but there are more data sets I'm using. This is the usual thing in our type of like international finance literature. So elections come from the World Bank data set on political institutions. State-level politics is very well organized and discussed on the stateline.org. For the form-level data, I use Azaris. So what is my regret? I'm going to get to this investment efficiency measure. But essentially, it's a big multidimensional panel. When I regress investment efficiency at the form level, on form fixed effects, on time fixed effects, I have election dummy, and I have a bunch of country level controls. I have form level controls. So they usually come from previous papers. I control for operating leverage, financial leverage, liquidity size, R&D. I control for economic variables that are lagged. I control for institutional variables. I control for variability of those variables. And the hardest control was to, I pretty much, I tried to exclude the possibility that it's not just the election uncertainty that drives the result, but it's maybe, how macroeconomic news are released or how election news are released. So what I do, now I know that I should use this world access data set, but I just go to the newspapers and I run them through Egyptian newspapers, and I run it through Google Translate, and I count the number of articles they talk about particular subjects. So I have a lot of controls. What does my neighboring methodology looks like? Well, I already previewed it, but essentially, let's say I take Indiana and Ohio, right? And Indiana borders with Michigan, Ohio, Kentucky, and Illinois. And I write the equation for investment efficiency as the function of election for Indiana and Ohio. And what's nice is that when there is election in Indiana, gubernatorial election, there is no election in Ohio. And I just say, well, it is my assumption that it's a function of form observed characteristics, form unobserved characteristics, state unobserved characteristics, time unobserved characteristics. So I pretty much do matching by industry and by size. And only recently I discovered that what I thought I created myself, it would be some subsample, what's called now, there's good methodology, a couple of papers from MIT, what's called like synthetic control method, right? And it's a wonderful method. It's a wonderful method. So, and when I take the difference, those effects disappear, and what I have the effect of elections and the difference in observed characteristics, yes. I use CompuStat forms, and I look at the companies with 50% of sales within one state, although those data don't exist. I don't look at incorporation. I look at their sales, right? There's now arguments that your headquarters and your state of operation, uncertainty about taxes, uncertainty about demand condition, that matters more than the legal codes in Delaware where every company is, yes. Yeah, it doesn't exist. Yeah, that's a good way. So we actually do it in finance. I didn't create it, but I did replicate it. So you take 10K, imagine 10K, 3,000 pages for every company. You run it through language software, and you count the numbers in this 10K where they talk about sales in the particular states, right? If you run Walmart financial statement, every state is going to be mentioned there multiple times, right? If you run a local company like Casey Stores in Iowa, they mention Iowa, maybe Illinois. So it's not a perfect measure, but this is probably, right now, the only way we can do it. So I do look at how concentrated they are. All right, what I mean by capital allocation? Well, here, yes. And as far as I remember, Gary is in Indiana. No, Gary is in, yeah. This is, yes, this is a good point. This is a good point. This was the second time I hear it, and this is what I need to think about. This is a very good point, that this competition can be kind of non-trivial. So this is a good point. I need to think about this. So, well, I'm sure something can be done, right? Because right. Yeah, elections an election in Illinois might affect a bunch of companies in Iowa, right? So this is a good point. I will definitely try to do something about it. So how do I measure capital efficiency? Well, that comes from my previous work, which was refined. There were some recent papers. Rick Green had a paper on like econometric aspects of how we measure capital allocation. But essentially, this is, I want to be very careful because, we don't know how to measure Q, and here I'm trying to measure marginal Q. But we use it, and, we try to make it better and better. But essentially, it becomes the kind of like a sort of change in value scaled by the change in fixed assets. And we make some modifications. We try to estimate the growth rate of the company, depreciation rate, rate of disbursement, and we expand this equation. And essentially what we do, think about this. You can do it by industry, you can do it by country. You collect information on value of equity, value of debt, you scale it by fixed assets, and you regress it on the growth rate and fixed assets. And you have to control for a bunch of things like dividends and share repurchase, the many terms here. And essentially, you try to estimate this effect, which you call Q, and it's a derivative. But essentially, this Q greater than 1 would represent, on average, if you run this panel for every country, this Q greater than 1 would represent underinvestment, less than 1 it would represent overinvestment. There are tax issues there, so we try to refine this methodology, take care of the taxes. So you can either run this regression at the country level, then you'll have one level per country. So it works for some of my tests. It doesn't work for other of my tests because I need firm level variable. So what we do, we also say, well, we don't know what the optimal level of Q is. There is taxation, there is delay in investment, many issues there. So we say, well, let's say we say that on average, companies allocate capital efficiently. We run this regression for every country, and we don't concentrate on this coefficient. Instead, we take residuals, right? And we say that residuals greater than 0, in the sense that your value increases faster than your growth in fixed assets. Residuals greater than 0, that would represent underinvestment. And the opposite, residuals less than 0, that would represent overinvestment. So for some of my tests, I need this marginal Q, the deviation from the optimal level at the country level. For other tests, I need it at the firm level, right? And I can also separate companies relative to their country average, companies that overinvest, that underinvest. Now, there's also some papers in the accounting literature trying to kind of formalize these arguments. So, how do I define politically sensitive, politically neutral firms? Well, surprisingly, it's more straightforward for the international sample. For the international sample, I look at the state ownership. And this is probably, at this point, the best I can do. I try to separate between cash flow rights and control rights. I go down those complicated pyramidal ownership chain and identify companies. Let's say I take a greater than 5%, that would be politically sensitive company, politically connected, and lower than that, that would be politically neutral. There is another measure I can use, for example, the reliance on government contracts, right? You can identify companies that rely more on government contracts. Defense spending, shipbuilding, surprisingly radio, maybe not surprisingly in many countries, radio and television. This would be politically sensitive. Companies belonging to those industries would be politically sensitive. Food, soft drinks, entertainment, these are usually politically neutral companies. This is for the international sample. I can do a better job for the US sample. For the US sample, I construct external political connections measure. That would be the proportion of the United States Congress whose party affiliation is the same as the current president for forms headquartered in the district of the congressman, right? Red, blue states, right? If you're in the red state, you're more inclined for the Republicans. If you're in the blue state, you're more inclined for the Democrats. I can collect information. I collect information and constructed the variable of political connections through the board of directors. Former congressman, current cannot serve on the board of directors. Former congressman serve on the board of directors. So those data are also available. And I also have political connections through political campaign contribution. Campaign contribution lobbying, that would be the amount of money managers and top CEOs spend on lobbying expenditures on political action committees. So there is like my international sample and US sample here is a little bit disjoint. I can do much better job for US companies, and for the international companies I use Yes.
Coming up to the most recent election, and Romney wasn't in power. He was like that.
Yeah, so that would actually, when the incumbent president was Obama, that would actually score low on political connections for me. But I understand, I completely see your point, because the degree of this political connectedness is pretty much a function of who wins the election in the future. The party in power, yes. Yes. Right. So, yes. So maybe I should take some kind of the, absolute value that no matter whom. Mm-hmm.
You're thinking of Halliburton. Yeah. But a party like that is going to be heavily influenced by the outcome of the election. So if you're using that influence by policy,
Right. So I think it would be, more appropriate to take the middle. That's a good point. Thank you. Yes. Well, election uncertainty, there are standard ex post measures, like difference between the vote share of the largest government party and the vote share of the largest opposition party. Well, more appropriate would be ex ante measure, and again, depends on the country. For the later sample, we can use the betting markets, right? There are several of them. For example, our famous Iowa electronic markets that is shown to lead the poll result rather than like the poll result. So I use different measures. So I'm going to show you the graphs. I'm not going to show. There are lots of regressions in this paper. I'm not going to show you the regressions. I'll show you the graphs and I'll explain the intuition. These graphs are built on the aggregate data. So this you can just. I'm absolutely fine if you treat them as correlations. So if you calculate this marginal Q and its deviation from optimal level, and for every country, the optimal level is different due to tax reasons. So the larger the bar, the more inefficient investment is. So if I just split according to US and international sample, well, yes, in the United States, investment on average more efficient than in other countries. The blue bar indicates the larger the bar, the more inefficient investment is. So in the United States, during election years, investment is more inefficient than during non-election years. This is also true for the international sample, and the difference from the international sample is larger. So during election years, on aggregate, if you don't differentiate between underinvestment and overinvestment, on aggregate, there is lower investment efficiency. This is marginal Q, let's say minus, under normal circumstances, -1 squared, -1 squared. But we can interpret it that it drops. Yeah, I'm not sure we can say that this is just half as efficient, as that the efficiency drops by half. I need to look at the interpretation how we. Yeah, so even if the bar is. So no, what it means is that So let's say that it's on average companies overinvest. So it becomes from 0.9 during election years. One is optimal. Well, this is 0.1. This is not a big drop. This is not actually a big drop. That's a small drop, right? It's 0.05, and this is already squared. So. Yeah, I need to think about this, how to interpret this, like how to estimate like economic significance, right? This one can be a little bit tricky. So if we split, look under investment and over investment. So let's say this is some kind of like aggregate optimal investment. We want it to be close to 1. We split the entire sample, US and international, into politically sensitive, connected, and politically neutral companies. What we observe is that, on average, politically sensitive companies, marginal Q is less than 1, so they overinvest. Politically neutral companies, they underinvest. What happens during the election years? The overinvestment problem becomes larger for politically connected companies. The underinvestment problem becomes larger for political neutral companies. So it also goes kind of in the right direction. And for the politically connected companies, the effect disappears if a chief executive, the politician, faces term limit, right? They just don't care about it. So then I have more like refined tests. For example, for this informational view of investment, the information quality decreases. What I do, it's a simple regression. It's like from the previous papers. You regress investment on Q, on elections, and interaction of Q with elections, right? And a bunch of controls. And what we observe is that investment becomes more disjoint from Q during election years. And one of the interpretations in finance we give to this result is that managers are less likely to follow price signals. They do investment, but it becomes disjoint from Q. So this is the effect internationally and the United States using gubernatorial elections or national elections. This is true for the United States and internationally. Investment follows less Q, subject to the criticism that Q can be mismeasured, so and other things. And the effect, I tried to quantify the effect there, and it was kind of like hard because I had to find some other events, right? What happens to investment to Q sensitivity during some kind of other informational effects? And there is an RFS published paper showing that the sensitivity increases by 12% or 16% for international companies that cross-list in the United States. Better information, right? Investment becomes more linked to Q. And that's what I find. So at least now I can quantify the effect of election on average is similar to the effect if you cross-list, right, on better stock exchanges. So this is another result. Then the reversal effect, again, the closer it gets to 1, the better investment efficiency is. For politically sensitive companies, it seems that you have let's start from politically neutral companies. You have, for politically neutral companies, you have underinvestment, and that becomes the result. Pretty much it gets closer to 1 year after election. It gets closer to the optimal level for politically neutral for politically connected companies that overinvest, but not during the first year of election. During election plus year 2, election plus year 3. So I don't have a perfect interpretation of this result, but there seems to be the reversal effect, and that's what probably we should expect. The tricky part with 4-year elections is the following, that once you get to election plus 3, plus 4, you're already in the new election cycle. So then I have other results. For example, I have a measure of stock price informativeness, which is, Lyubish had the question there. So I look at analyst forecast error. I look at the sensitivity of return with respect to future earnings. I have some measure of insider trading. I have the measure of stock price reaction to earnings announcement. And in general, what I observe is that those measures, what we call noisier stock prices, those measures increase. Stock prices become noisier, right? So they incorporate more market type of news, aggregate type of news, and lower amount of what we call firm-specific news. So I also have those results. Then another test I conduct is, imagine, so I have every country, right? So for every country, I have election years, non-election years, right? So what I do, I say, well, investment efficiency is lower during election years, right? So I calculate this country-specific drop in election efficiency, right? So I have one number for every election relative to non-election, one number how misallocated capital becomes for every country. And then I do what probably we shouldn't do, but I'm curious. I just say there are so many country-specific variables. I'm just going to do almost blindly. I'm going to take this drop and regress. And I want to see whether the drop in capital allocation efficiency in Russia, let's say, is larger than the United States. And what variables explain it, right? So what would be the variables? Well, the first suspect would be all kind of institutional variables, right? That would be LLSV variables, investor protection, rule of law. Then I look at corruption. I add corruption, right? And I look some political variables. So one of the interesting political variables I found was disclosure by politicians, right? Whether politicians, the member of the parliament or chief executive, are by law required to disclose their finances, right, and their business interests. And there is actually big variation there. Like in Singapore, you don't have to disclose it by law, and they don't disclose. But in Thailand, they do. It doesn't mean that they do it always truthfully. But for example, in Russia, there are always the scandals. They're supposed to disclose. They have to disclose the finances of their relatives, for example, right? As far as I know, in South Korea, there are no exact rules like this. So what's really interesting, and in terms of finance, we are used to that institutional variables explain everything, right? And nothing else matters. Here, I find something interesting. I actually find that corruption explains this drop in relative capital allocation efficiency, and disclosure by politician, right? By politicians. But variables like rule of law or the general level of economic development, they don't explain this variable. So if you want to see, this is the graph. You can just think about that. The longer the line, the greater the drop in investment efficiency in election years relative to non-election years, right? So what do we have up there? Well, we have Korea, Malaysia, Pakistan, maybe like not so surprised. And this number is less than 1. then, maybe just statistically, mechanically, I find that there is no drop actually on average capital allocated during election years as well as during non-election years. So, for example, Switzerland and Thailand, right? So I construct this measure, and what I observe is that institutional variables, interestingly, and the level of economic development don't explain it on country-by-country basis, right? But corruption explains, and disclosure by politicians. And they try to provide the argument that this is the case, like politically connected companies, they cater to the politicians, and this is really harder to detect by investors and by the regulation authorities. And this is where you have this tremendous, tremendous capital misallocation. Again, you can think about Russia trying to build new plants, trying to hire labor during election years. You can think about South Korea, where every company has a budget on the side, right? I don't know if it's true or not. That's what I've heard. They have a budget on the side which pretty much has written on it, this is for the election years. Not necessarily to bribe politicians, for political campaigns, for lobbying, etc., etc. Yes?
I would expect that there would be this inflicting tendency of election uncertainty, that at the time of the election, when in a country where elections actually settle big questions, there would be great uncertainty. But those countries, because elections address a lot of issues over a longer period of time, have greater inflexible decisions. So that there would be like short run, or for instance, like over the cycle, there would be more uncertainty or less legitimacy of the election. But over a longer trend, those countries would have greater inflexible decisions.
Right. This is something very interesting to explore, right? And this is something I can do for relatively long electoral cycles. I can pick some countries, and I can pick specific events when these big issues are and how they get resolved, right? And there may be many examples, right? Like, yeah. I understand the question, and I completely agree that would be something really, really interesting to explore. Yes, and yes. Oh, yeah, I'm almost done. And then I have a performance regressions when essentially, I have this measure of firm level capital misallocation, and I pretty much run the regression of company performance. And by company performance, I look at the ex post election plus 1 year stock market, their stock return performance. I look at their accounting performance. I just look at their market to book. And what I show that the largest this deviation from investment efficiency is, the greater underperformance is, right? And I also try to quantify it. So I do find that capital misallocation results in at least a temporary decrease in company performance. So what am I after in this paper? Political uncertainty reduces investment efficiency and decreases firm performance. Both information and political views of investment are valid, and I try to differentiate between the two. I show that underinvestment is more likely to happen for politically neutral companies. Overinvestment is more likely to happen for politically sensitive, politically connected companies. Drop in investment efficiency around elections is large in countries with greater corruption, state interference, and less accountable politicians. Neighboring states' methodology for governor elections. And again, when I found this governor elections result, when I replicated Julian Duke paper using governor elections, I was kind of surprised. I didn't expect that governance matters so much. But now there are 2 other papers showing this result. And there are other papers showing that, for example, municipal bonds spreads increase during gubernatorial elections. So the policy implication here is always tricky, because you can say important for policymakers to find mechanisms to reduce unnecessary political uncertainty. My president, I'm Russian citizen, Putin. No political uncertainty, great. So it's hard to put those policy implications, right? Because you need a thriving democracy for many other things. And I'm welcome to alternative stories. And thank you so much.